Hello folks, how are you? I hope you all doing well, and today I would like to share something new about options you might did not know. So have you ever wondered why do airlines, tech companies and giant businesses use options? Are options only for traders trying to make quick money? Absolutely not. In fact, many billion-dollar companies use options mainly for protection. Yes, you heard it right. Options are not just for profit, they are also used like insurance. And today I will explain why people trade options, why big companies use them, real life hedging examples, and the dangerous reality beginners ignore. This video will completely change how you see options trading, so watch it carefully till the end. So, yes, firstly, most beginners think like options are only for gambling or quick money, but reality is very different. Actually, many professional investors and companies use options mainly to reduce the risk. This is called hedging. So, what is hedging? Hedging simply means protection against future uncertainty, very similar to insurance. For example, you buy health insurance not because you want illness, but because you want protection if something goes wrong, right? Similarly, companies use options to protect themselves from fuel price rise, currency fluctuations, market crashes. This protection is called hedging. Understood, guys? So now let's take one of the best real life examples to understand this concept, which is airlines. Airlines use huge amount of jet fuel daily, and fuel prices keep changing constantly. Now imagine this situation. Suppose an airline sells flight tickets today. After 3 months, fuel prices suddenly double. Now their expense increase massively. This can destroy their profits. So what do airlines do? They use options and hedging contracts to protect themselves from future fuel price increases. One of the real life famous example is Southwest Airlines. For years, Southwest Airlines used fuel hedging strategies to protect itself from rising fuel prices during major oil price spikes. Their hedging strategy reportedly saved billions of dollars compared to their competitors. This shows options are not just for retail traders. Even huge companies use them too, like Apple and many more big giant companies. Apple earns revenue globally, right? Different countries, different currencies. Now currency values keep changing daily. Suppose dollar suddenly becomes stronger, then Apple's foreign earnings may lose value after currency conversion. So companies use currency hedging strategy using options and forward contracts to reduce this risk. Now after understanding companies, let's understand retail traders. What they will do. People mainly trade options because of three reasons. Firstly, small capital. Being shares Buying shares directly needs large money, but options allow traders to participate with smaller capital. This becomes very attractive to them. And secondly, possibility of big returns. Options premiums can move very fast. Sometimes small market movement creates huge percentage of returns, and this attracts many traders emotionally, especially after seeing profit screenshot on social media, right guys? And thirdly, hedging and protection. Like smart investors use options not just for profit but for protection. For example, if someone has 10 lakh rupees portfolio, they may buy put options during uncertain market conditions. If market crashes, put options may reduce losses of there. Understood? Thank you guys.